Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, January 3, 2017. Happy New Year to everybody. Welcome to 2017. One thing I can tell you right out of the chute is 2017 promises to be an extremely volatile year. We should have more or less a bullish first half of the year and then a very bearish second half of the year. We'll get more into that as the weeks and months go on, but I just want to kind of set the stage for what the likely big picture scenario is. Now let's narrow down and take a look at where we are today in the SPY, because frankly, it's pretty simple of where we are, and I think I've got a pretty easy way to explain this. You'll notice I've got a 226.59 on the chart. That's the blue line. Why did I use blue? Just for a change, no reason. That number is extremely important. If we close the day or even hourly above that number, consecutively, hours above that number, and then a daily close above that number, that would be the first indication and potentially the last indication you get where the market's going to go higher. Most not even most likely, we'll make new highs, and we'll discuss numbers outside of the 229, 230 if we get there. Outside of that, the 226.59 should contain the market over the coming, let's say, next week or two. That's my indication. That's what I think is probable. However, it doesn't matter what I think. What matters is the price action and where the market's going. So all we need to know is 226.59 above is bullish, below is bearish. That's our daily pivot point. Now let's discuss if we should continue down further in the markets, which I think is the likely scenario. Where are the numbers on the downside? Well, I actually have a handful of numbers. 222.73. That's not a specific number. The actual mathematical number is slightly higher than that. But what I did was I put the line at the pivot low from Friday. And the reason I did that is because the likely scenario is we'll have to go in and retest that pivot low at a minimum. That's price level number one. Price level number two would be all the way down just below 221. That's an area that should be supportive of the market for a multitude of reasons. A, you have a bunch of consolidation right in this zone right here. That's number one, okay? Number two is it's a normal retracement from this pivot low down in July up to the pivot high of recent last month. That comes in at a 2.5 retrace. So I think that level is extremely good. And then you have just below that, which is a better level, is a gap fill right here. Let me point out the gap fill. Okay, we could fill this gap. We should fill that gap. Also coincides today, but as the days move on, this will change with the 50-period moving average. That's the upsloping blue trend line. Okay. And this zone also happens to be a 382 retrace from the same pivot low down here to the pivot high from last month. So there's another level that should be very, very good for the market. If we should continue down farther than that, and I'm not 100% sure we will or we won't, it's really more a matter of time than price. And I believe the timing for a low in January, should we get one, should come in somewhere around the inauguration. The level below that at 217, that would be a level that we would hit if the market had more of a wide open break lower, if you will. So that would put the S&P down at around just below 2,200, and today we sit at about 2257 on the S&P 500. So that would represent about roughly 60 handles lower in the S&P from where we are today. And if you take that number from the highs that were made in December, up on December 13th, and you take the high to the low that I'm proposing could be a low down here at 217 if we got down that far, that would represent somewhere between a 90 to 95 point or 95 handle decline in the S&P 500. That smells like a correction. Not a correction. It smells like well, it is a correction, but it's not a bear market by any stretch. It's just a correction. And for us to take some of the air out of the market, whether it's at 220, 219.67, 217, it really doesn't matter. If we get down to these numbers sometime around the third week in January, I think that's an area we're going to be looking for a low. So whether we come in at 219.67, 217, in that zone, it's more predicated on when we get there than the actual number itself. What I'm giving you guys here is a guideline of areas that certainly should be supportive of the market. You're going to get reactionary bounces from these levels one way or the other, generally speaking, most likely. On the flip side of that, could we just run up and make new highs in the S&P right now? Sure we could. As long as we got above 226.59, that would be the case. That would be the bullish case. As long as we remain closing below that level, the blue line, on a daily chart closing basis, then the lower numbers are the higher probability, and that's the way it works. All right, let's go over to the IWM and take a look there. So you see where we are in the IWM. We got to close on Friday, on the last trading day of the year. We really closed below the upsloping trend line drawn over from the monthly chart. And you can see here that that's a very, very pivotal number or pivotal area on the chart. That level, closing above that level on a monthly basis, would be very bullish for the market. We're close. We weren't able to do it in December. We'll see what happens in January. If the market sells off between now and the third week in January, the likely scenario is we won't close above that level in the month of January. But that's not to say that we can't in future months. But let's just be aware of where we are. Let's go down to the daily and look at the IWM. The IWM, it gapped higher and we finished lower than we opened. That's why you see the red candle. But the IWM still was up 90 cents today, or about 0.7%, slightly less than the spider, but not enough to be meaningful. They were basically, in terms of percentage, up about the same as each other. They were up on par with each other. Also, what you can see here is a bullish pattern. So you have an up move, little pullback, another up move. You're making a bullish consolidation pattern, okay, but we're below the 20-period moving average, and the likely scenario is we're going to come down and test some of these lower levels. So I wouldn't be looking for a long trade in any of the markets until we got some kind of a definitive pivot for the month of January. That's a little tricky. It may happen tomorrow, and it may happen 2 weeks from now. We'll see. January needs to be handled with caution, and until we can see that timing factor that I discussed before, in and around the week of the inauguration, that's the most important time, I believe, for January, at least from where I sit. From my vantage point, that's going to be an important pivot point. Let's just judge the market based on where the spider closes each and every day. If we're above the specific number on a bullish side, it is what it is. And the IWM will either be leading the way or will follow. On the flip side, if we're headed lower, the IWM will most likely be heading lower first and leading the market in that direction. The transports were a little bit weaker today. They recovered slightly, but as you can see, we got below the important number of 91.42, And we tested that. We came back to that level today, this morning, and retested that level and failed and traded lower. So it looks to be we're headed lower in the transports. 88.90 is the next likely number on the downside. You have the 50-period moving average as well as a little bit of consolidation here. That number would also be supportive of the market if the 88.90 didn't hold. So there's a lot of chart support right in this area right here. This is an area where the market would be very supportive of these prices, okay? Not much more to add in the transports. Down 20 points today. They were down much more earlier in the day. Pardon me. They were up much more earlier in the day. In fact, they were up about 120 points at one point in time, finished down. That's a reversal, not a bullish sign at all. So when you look at that and you say, well, the transports had a fake out rally. They came back to test the 91.42 and failed and had a pretty steep decline. If you look at it like this, here's a 10-minute chart. Let's look at what really happened. Okay, that's a collapse, consolidation, another collapse, and a bearish wedge pattern trading toward the 50-period moving average at about 90.36. So there's nothing really good right now, at least on the short-term transportation chart. If you look at the hourly chart, this is an hourly chart reversal and a bearish pattern. So after the first hour of the day, we basically traded sideways in this bearish pattern underneath the moving averages all day long. That's a bearish signal. So we want to be aware of these things. Any bearish or bullish patterns, specifically in markets that are leading indicators, the transports, as is the IWM, is a leading indicator of the market. So when we see something like this, we need to be aware of it. We need to notice it. We need to take it, put it on the table with the other pieces to the puzzle because it's a very important component. The transports are saying lower prices coming. Let's head over to the gold market, and we had a nice little rally in gold today. Let me go over to, this is the hourly chart. Let me go over to the daily chart. And we'll see here now, what's interesting is we're all of a sudden starting to make a bullish consolidation pattern above the 20-period moving average, and that's a bullish sign, okay? So we came in this morning, and we had a nice rally stewing or brewing in the gold market, pulled back a little bit, didn't quite get up to the 1170. That should be a fair amount of resistance for the market, but the longer we consolidate sideways, the more apt gold will be to trade through that level. Right now, we really don't have enough sideways activity to trade through that level, in my opinion, in one shot. However, another, 3 or 4 days of sideways activity in the gold market, and we will have made enough sideways activity or action to trade through the 1170. Let's just watch it one day at a time. So far, so good. It looks to be like a decent low today, but I'm not necessarily sold from a longer-term perspective that we have a good low and we're going to get a very robust rally that we've been discussing in gold just yet. I think the jury's still out. We need to just take it one day at a time and see what happens. We do have some positive activity in GDX today. I'll talk about that for a second. So we're butting up against the 50-period moving average. Now this is basically the third day in a row that we're trading around this area where the 50-period moving average is right now. Our buy level was 2050. We're at 2176. We really need to clear this area. If we clear the 50-period moving average and we clear this high over here, 2224, then the next one's going to be 2275. 2275 would be the next area of resistance. However, what I will tell you is the longer we consolidate like this, okay, the less important 2275 will become, and we may end up just making a run for the 200 period moving average. Not all in one shot, but the longer we consolidate below this area, okay, or in this zone, the less the 2275 is going to be resistant to the market. That's the point. All right, but so far so good in GDX. Let's backtrack a little bit to silver. Silver had a nice healthy update today. It was into the 20 period moving average and backed off. Let's see if silver can muster some upside, but you know we do have hurdles on the upside. 1669, 1670 is going to be an important number, and then another very important number is $17. And so these are areas where the metals markets, or at least the silver market, will find resistance in the charts or resistance on the chart. One thing you need to keep in mind is, as much as this looks like we've carved out or are carving out a bottom, what we need to be aware of is pretty obvious. This is a bearish pattern. Okay, so we have a down move, and we're really just consolidating sideways below the moving averages, and this could be setting up for another move lower. Now, what I will tell you is that bearish patterns and bullish patterns, bearish patterns at lows on charts, while this is not an all-time low, it's at a near-term low. Bearish patterns at lows and bullish patterns at highs will have a tendency to fail. So while even though this is a bearish pattern in the making, I'm kind of hoping it fails and we go higher. If we do go higher, we're also going to find resistance at the 50 period moving average, which will at the time most likely coincide roughly with the $17 area. But this is still a bearish pattern any way you look at it. Let's go over to the crude oil market, which got really hammered today, down $1.20 and change. And you can see here we got below the 20 period moving average, and we're moving lower. On one hand, this is bearish. On the other hand, there's really nothing wrong with the chart. It's still in a bullish pattern, okay? We have an up move, and this is a bullish consolidation pattern. There's nothing wrong here. So how low can we go? Where would the downside be? Where are we going to find support for the crude oil market? Well, the first natural area is 52, and we almost got there today. Below that is 51.5, and then 51. And those are the areas, and they're not just because they sound like round numbers. They happen to be the areas, I'm going to put 51, that are important. I'm not going to put 52 on there. We almost got there today, and therefore I don't think it's as important as it would have been either today or had we not gotten close. We got within, I think, 15 cents or something. The low today was 52.11, so we got within 11 cents. So that the 52 is no longer as important. 51.50 and then 51. Below that, your moving averages at 50 and below 50 will be supportive of the market also. That may actually present a better buying opportunity based on time. If we came into the moving averages around the same time that the stock market, the spider, was coming into the numbers we spoke about before, and it just so happened that maybe that would be at the same time as the inauguration of Donald Trump, then that would be interesting. We'll keep our eye on that. We'll keep looking for that, but we have to take it one day at a time as it stands right now. So right now, pretty good reversal day in crude. From a longer-term perspective, nothing happened damaging on the chart. From a shorter-term perspective, we have lower to go, most likely. And by the way, all these lower numbers that I've talked about in various markets, you have to realize, and I know you guys do, all these things don't have to happen in one day. We may have another update tomorrow. We may have an update on Thursday. But in the end, my work is telling me that we should be lower several days from now than we are today. If something changes and we hit the higher numbers in the spider, for example, and we turn bullish, so be it. That's fine. I'm happy to be bullish. I'm happy to be bearish. Whatever it is, I don't really care which way it's going. I just want to be correct. And knowing where we're wrong is important in determining if we're correct or not. Let's head over to the 30-year bond, the bond market. Bond market's a little bit of an uptick, working off, this is a severely oversold condition. Obviously, the last few days have been working off that condition. I think we're going to find a pretty good level of resistance at 151. Actually, I think I have that wrong. 151.10 is the number. If we can clear, that's going to be a ton of resistance, by the way. If we can clear 151.10 on a daily chart closing basis, then we'll trade most likely very rapidly into the neighborhood in which the 50-period moving average is. It'll be just under 153 is where we would find another fair amount of resistance. So there's your number. It's not 153, 152.29. We're just going to call it 153. Let me change that to 153. Okay. So that's the second area of resistance, also going to be resistant because of the 50-period moving average sloping down. This was the breakdown point. This is the bearish consolidation. Here's another breakdown point. There's all kinds of reasons why these two levels are going to be resistant to the bond market. Bigger picture, lower bond prices coming, higher yields coming. Let's go over to the dollar. And the dollar had a slight uptick today. Nothing's changed on the dollar. You can see last week we came in to test the 20-period moving average. This little gap fill here, okay? We didn't fill the gap. It came not even close, really. Just tested the 20-period moving average, bounced off that. In a sense, all we're doing is continuing a bullish consolidation pattern, building energy to get up to 105. Nothing's changed. I sound like a broken record, I'm sorry. But until we get to 105, that's going to be the story until and unless we have some kind of breakdown below par, below 100, which I don't expect. I don't expect that before we get to 105, certainly. So there you have it. Welcome to 2017. It's going to promise, or it promises to be, a very, very interesting year. Remember, first half primarily bullish, second half bearish, a lot of volatility, and the second half bearish is probably going to be a whopper, and we'll get more and more and more into that as the weeks and months go on. I'm David Frost. Thanks for tuning in for another episode of Common Sense Market Analysis.